Hello, welcome to my channel. I'm Stella. I specialize in accounting, tax, and investments. Today's topic is dividend income. Specifically, it's tax strategies for dividend income. If you're investing in stocks, or if you're thinking of growing passive income, this video is for you. So dividend income is one of the smartest ways to grow wealth. But this is also an area where many people tend to overpay taxes. Today we'll cover different types of dividends, such as qualified, non-qualified, and others. Meanwhile, we'll talk about how they are taxed and tax saving strategies. Okay, let's dive in. So what exactly are dividends? Well, dividends are a portion of companies' profits paid out to shareholders. Well, not all dividends are created equal, tax-wise that is. Let's break it down. First, let me introduce qualified dividends. They are paid by U.S. companies or qualifying foreign companies on stocks held for a specific period. Qualified dividends get a favorable tax treatment, usually the long-term capital gains rate, which is 0%, 15%, or 20%, depending on your taxable income. Examples of qualified dividends are dividends from blue-chip stocks like Apple, Microsoft, or Coca-Cola, often fall into this category. The key here is holding period. You need to hold a stock for at least 60 days within the 121-day period, starting 60 days before the ex-dividend date. Next on the list are non-qualified dividends, which is ordinary dividends. Non-qualified dividends are dividends that don't meet the criteria for qualified status, often from REITs, MLPs, or certain foreign companies. They are taxed at your ordinary income rate, which can be as high as 37% in the US. Examples are dividends from some REITs, real estate investment trusts, or dividends from foreign companies that doesn't meet IRS criteria. Since non-qualified dividends get taxed at higher rates, we'll go over some strategies to minimize that impact in just a minute. In addition to qualified and non-qualified, there are a few more. 1. Capital gain distributions, often from mutual funds, taxed at capital gain rates. 2. Return of capital, not taxable income, but reduces your cost basis, impacting future capital gains. Dividend reinvestment plans, DRIPs. While reinvested dividends buy more shares, they are still taxable in the year received, an important detail many investors miss. Now we know types of dividends. Let's look at how we can keep more of that income by making smart tax moves. First, focus on qualified dividends. Since qualified dividends are taxed at a lower rate, building a portfolio of qualified dividend-paying stocks is a great way to maximize after-tax returns. Secondly, aim to meet holding period requirements by holding long-term. Then, using dividend growth investing strategy, that is to focus on companies with a strong history of increasing dividends. Use tax-advantaged accounts. Another way to shelter dividend income from taxes is by using accounts like Roth IRA. Dividends grow tax-free and you won't pay taxes on withdrawals in retirement. Traditional IRA, 401k. Dividends grow tax-deferred until you withdraw, ideally when you are in a lower tax bracket. Health Savings Account (HSA), often overlooked, but can be a triple tax advantaged way to grow investments, including dividends. By holding high dividend stocks in these accounts, you can significantly cut your tax bill. Hold REITs and non-qualified dividend stocks in tax-advantaged accounts. Since non-qualified dividends are taxed at ordinary income rates, consider holding them in your IRA or 401k to defer or eliminate taxes. REIT dividends often don't qualify for lower rates, but can still offer great returns, just better sheltered in a tax-advantaged account. Harvest tax losses to offset dividend income. Sell underperforming investments to generate losses, which can offset capital gains, and up to $3,000 of ordinary income, including non-qualified dividends. You may check out my video about tax loss harvesting. This strategy pairs well with rebalancing your portfolio. Consider your income bracket. If your income falls below certain thresholds, you might actually pay 0% tax on qualified dividends. So, planning your income streams can help you stay in a lower bracket. For 2025, single filers earning less than $44,625 and a joint filer under $89,250 may pay 0% on qualified dividends. Before we wrap up, let's make sure you don't fall into these common dividend tax traps. Ignoring holding periods, losing qualified dividend status because you sold too soon. Not reporting reinvested dividends. Even if you reinvest, it's still taxable income. Forgetting to adjust the cost basis for return of capital. This could mean higher capital gains tax down the road. Mismatched asset allocation, holding non-qualified dividend stocks in taxable accounts, while keeping qualified ones in tax-advantaged accounts, which often isn't optimal. Dividend income is a fantastic way to build wealth, but smart tax strategies can make a world of difference in your returns. To sum it up, prioritize qualified dividends, leverage tax-advantaged accounts, and be strategic with your holdings. Which dividend tax strategy do you find the most useful? Let me know in the comments.